Hello and welcome to Follow the Money. I'm Robert Tan. Join us as we explore the tools and insights you need to jumpstart your financial journey. Latest figures from the BSP indicate a decline in foreign exchange buffers, with gross international reserves slipping to 104.6 billion US dollars by end April, down 2.1 billion US dollars for end of March. Meanwhile, the country's external financial transactions posted a larger shortfall, jumping to 2.6 billion US dollars in April from the 1.97 billion US dollar deficit in March. And joining us today to tell us what these figures mean is Mr. Angelo Taningco, Chief Economist at Security Bank. Good afternoon, Sir Taningco. Welcome to Follow the Money.
Thank you for having me, Robert.
Okay, sir, to start us off now, with the balance of payments deficit widening to 2.56 billion in April. Now, this is wider than the 639 million gap a year ago and the 1.97 billion shortfall in March. Now, what do you think is the reason for this?
I think the balance of payments deficit in April was partly due to the trade deficit, which we think has widened for that same month. And in particular, the trade in goods balance, we think, may have turned negative again and bigger compared to the previous period in light of the import growth still outpacing exports. Exports still facing headwinds in light of the higher global tariffs, which were triggered in early April. And also you have the importation, we think, has increased sharply because China is our biggest source of imports. And we believe that the higher global tariffs that even China is facing versus the US may have translated into more importation by the Philippines coming from its biggest import source.
Now, you mentioned that the trade deficit is one of the reasons for the shortfall. Now, the BSP said the wider balance of payment deficit is also due to the government's payments on its external debt. Do you agree with this?
Yes, that's also part of the BOP transactions. And combined with the current account balance, which we think was again in a deficit position in April, we believe this has translated into that $2.6 billion of BOP deficit in April, and resulting in a cumulative BOP deficit position of about $5.5 billion for the January to April period.
Now, looking at these causes, what do you think is the outlook for the balance of payments in May and for the rest of the year?
We now see the balance of payments to be in a deficit position for the full year 2025, which is a reversal from last year's surplus. And our projection now is at $5 billion for the full year BOP deficit. And we think that this is largely driven by a wider current account deficit because, as mentioned, you have potentially a bigger trade in goods deficit in light of the stronger import growth versus exports. Secondly, we think that the net receipts in services trade may be smaller this year compared to last year. Because you may have this trade in travel services, again culminating in a smaller net receipts combined with the tourism activity now potentially weakening. In fact, the 4-month period of visitor arrivals, we saw that to dip by nearly 1% year on year. So likewise, we are seeing more headwinds facing our remittances. Our remittances tend to grow by about 3% per year. But this time around, we might see weaker remittance coming from the United States. Uh, Year to date, remittance growth coming from the US alone was only about 1% year on year.
Now,
And yeah.
Now, with all these shortfalls that we are seeing, how do you see the local economy in the standpoint of the normal working people, and also how foreign investors are looking into our economy right now?
Our economy is mostly household consumption driven. More than 70% of our GDP is coming from household spending. But household spending is now growing by slightly above 5%, which tends to mimic that of the GDP as we saw in the first quarter. But in the previous quarters, the household consumption was underperforming overall economic growth. So we think that this poses a downside risk to the full year economic performance, especially if we continue to see underperformance from household spending. And that could translate into GDP growth for the year that may fall short again versus the government's target of at least 6%.
Now, on another note, the Bangko Sentral ng Pilipinas is planning to set a fixed 2% inflation target next year, replacing the current 2 to 4% range. Now, do you agree with the central bank's plan?
I think this plan for having a fixed inflation target would be consistent with several other countries' practice of having the same type of inflation target. So I think this is just to be more comparable with the other countries in terms of having a fixed inflation target as opposed to a target range.
Okay. Now, what is your outlook now? Let's look at talk about the bond markets, the yields on government securities traded in the secondary market, which ended pretty mixed last week. Now, why do you think this happened?
Well, last week the local bond yields basically were mixed because on one hand, you have still expectations of more rate cuts. The BSP governor remarking that there could be two more rate cuts by year end, and that is consistent also with our view. But on the other hand, long-term yields tend to move higher because it basically tracks the US Treasury yields. And the reason why long-term Treasury yields in the US went up with the 30-year yield topping 5% is because of the heightened fiscal risk surrounding the US after Moody's downgraded US credit rating, and also because of the tax cut bill which passed the US House of Representatives that could raise the US budget deficit and debt, and therefore raising the term premium associated with the yields.
But how does that affect emerging markets like the Philippines?
Well, over time, we could see local bond yields to move downward in light of the policy rate cut expectation. So in our case, we still think that the local central bank will cut by another 25 basis point next month, and also possibly in August, so a back-to-back rate cut, and therefore a total of 75 basis point cut could commence for this year, and therefore that can help drive down borrowing costs, which in turn could stimulate domestic demand and overall economic activity.
Now, looking at the AMRO projects, the Philippine economy will grow this quarter as you mentioned, household consumption improves amid the easing inflation now, and exporters may have front-loaded production amid the pause in the U.S. reciprocal tariffs. Now, do you think the economy will reach the government's target range for this year?
Our current full-year GDP growth forecast is at 5.9%, so that's a notch below the minimum 6% target of the government. But it's better compared to previous 2 years when the GDP was close to around 5.5 to 5.6%. And we think its election spend will be having a bigger role this year in terms of spurring domestic demand, as well as government spending, which we saw outperform in the first quarter of the year.
Now, on another note, given the current political developments in the country, now such as the impending impeachment trial of Vice President Sara Duterte and the cabinet reorganization, do you still think these will affect investor optimism toward the country, those looking to see if they can invest back here?
Well, I think the retaining of the economic managers by the president shows continuity in pushing for much needed economic reforms, and therefore that can help investors in terms of having a clear outlook on the business environment within the economy. As regards the impeachment trial, it's part of the constitutional process, and I think investors and businesses will, of course, recognize this as part of the democracy, and therefore will be in a business as usual mood when it comes to their investments decision making.
A while ago, before we started the show, we were talking about what kind of communication does the business sector have with the government in terms of trying to help spur the economy. Is there a two-way street in terms of communication on the government asking the business sector on how it can help in spurring the economy?
Yes, I think they have a constant dialogue between business and government. There's, I believe, a private sector advisory council that the president and his economic managers continually meet and discuss the important measures that needed to be undertaken in order to push for much needed reforms in terms of creating jobs, in terms of increasing economic growth, and also in terms of having a more conducive investment climate for the country.
Okay, so we're just getting started, but Follow the Money will return right after this short break. We are back on Follow the Money with Security Bank Chief Economist, Mr. Angelo Taningco. Welcome back, sir. Before we went to break, we were talking about what kind of communication does the business sector have with the government in terms of maybe trying to help spur the economy. In your own point of view, what kind of communication or back and forth does the business sector need from the government for you to be able to help?
Well, especially now that the government and the business sector are collaborating in terms of discussing with their U.S. counterparts on what kind of trade agreement or deal needs to be completed as required by the U.S. So I think in this period of trade negotiation will show more constant communication and dialogue between business and government. And therefore, this will help relay to the U.S. What are the important asks that our business community would tend to request to have a better or more optimal trade relation between Philippines and the U.S. Other aspects, I think, will also require more constant dialogue, such as pushing for economic reforms in order to stimulate infrastructure development and also reduce the cost of doing business further and be able to attract much needed foreign capital in order to create more jobs locally and spur economic activity moving forward.
Yeah. Now, looking at the Philippine Stock Exchange Index, now what are your support and resistance levels on this, and how do you think it will perform this week?
Well, this week I think it will be in a range-bound mode because there's a lack of catalyst out there. And also we just finished with the earnings season for the first quarter. And we moving forward, we are still looking at an upside for the local benchmark PSEI. Our year-end target is set at 6,800, but at least for this week, we could see a range of between 6,200 and a high of about 6,600. And that will allow for more liquidity to take place in the local bourse and hopefully attract more foreign capital because since the start of the year we are still in a net foreign selling position, and that will basically drive more liquidity and more upside into the local market.
Now, looking at the stock exchange market now, could you share with us your current favorite stock pick and maybe explain to our viewers the rationale behind your choice?
Well, let me start first with the sectors. So, for example, we still like banks, and in the banking space in which we are overweight, we prefer BDO because of its market leadership, as well as Metro Bank given its dividend play. We are also overweight on the consumer retail segment, and that's partly because we now have a benign inflationary environment. Year to date, the inflation has averaged only 2%, which is at the lower bound of the target range of government. And therefore, we think this will help consumer spend improve. And within this space, we like pure gold because of its mass appeal and that it has been performing within our expectations, especially since the first quarter. Uh, in the other sectors that we like would be telcos, so we are also overweight in that sector. And within that segment, we like Converge. It has outperformed our expectation in terms of earnings in the first quarter. And also, we still like Globe Telecom because of the prospects for an IPO on its GCash. So these are some of the sectors and stocks that we prefer and that we have published also in our last strategy report last month.
So you see the digital space, telcos, and the banks and some they're the strong contenders in terms of those looking to invest their money in stocks. Is that what you mean?
Yes.
You were mentioning sometimes you're overweight. What does that mean to the normal person?
Overweight means that we see more upside to these sectors. So we basically are bullish on these sectors. And in terms of the preferred stocks that we mentioned earlier, so these are our top stock picks for each of the overweight sectors that we have currently.
Now, looking back at the recent shuffle in the president's cabinet, but President Marcos has retained his economic managers. Do you think this was the right decision?
Definitely, it provides continuity on economic policy. It provides no disruption to the economic plans and the targets that the government have in terms of meeting the GDP or inflation or even the trade targets. So in that sense, we think this will provide the business community clear picture on the continuity of economic reforms over the medium term.
And lastly, sir, before we end this, what can we expect in the next coming months in terms of the stock market, in terms of inflation, in terms of our economy? So is it still going to be bullish or should we be cautious?
I think in terms of the local economic fundamentals, we are upbeat. On GDP, we think second half it can grow by 6%, partly because of the low base effect. Second half of last year, it was only 5.2 to 5.3%. On inflation, there could be some sequential uptick, but only marginally. In fact, we are seeing full year inflation to average only 1.9%. And that's already a notch below the a minimum target of 2%. So therefore, we still see inflation to be in a benign stage. In terms of jobs or labor market, we think it's going to be healthy still throughout the rest of the year. Usually, the fourth quarter tends to offer the lowest unemployment rate because that's where you have holiday spending, that's where you have more tourist activity, and that creates more jobs. So less than 4% unemployment rate is what we have penciled in by year end, and that is historically low. Pre-pandemic unemployment rate tends to average between 5 to 6%. So that's still showing that there are many people who have jobs, and the income levels are still intact when it comes to spurring spending, especially coming from households.
And finally, any advice to those who want to start trading, those who want to start business, or the foreign community who are looking to invest here in the Philippines? Any advice for them?
I think it's important that now, given the information is flowing much faster, people have to be more cognizant of what's happening, not just domestically, but also internationally, because we are all interconnected. What's happening in the US or in the rest of the world have a bearing also on local economic activity. And therefore, we have to be, aware and cognizant of what's taking place in our business environment, not just within the Philippines, but also with the rest of the world.
Okay, with that, thank you for taking your time and joining us here and Follow the Money and giving your insight and advices. That was all the time we have now. We thank Mr. Angelo Taningco, Chief Economist at Security Bank, for helping us understand the BSP's report on the country's external financial standing. Before we go, this thought from Nobel laureate in economics, Paul Krugman. The real danger is that foreign investors will suddenly start pulling their money out. That's what reserves are for, to reassure those investors. And that's it for today's edition of Follow the Money. I'm Robert Tan. Thanks for watching. Keep it here on BNC, the Bilyonaryo News Channel, always on top.